if you look at Brent crude prices, they have fallen below the $75 per barrel mark. Now, this is the biggest intraday fall that we have seen since 1st May 2024. Yesterday, Brent crude dropped nearly 5.2% on an intraday basis, and crude prices are the lowest that we have seen since December 2023. Now, what is more important is that Brent crude has been on a downward trend, and it has been declining for the third consecutive month. In the month of July, it was down around 6.5%. August, it fell around 2.4%, and in the first few days of September, it has already declined nearly 6.7%. So why are we seeing this kind of a decline when it comes to crude oil prices? Firstly, OPEC Plus is expected to increase its production in the coming weeks. They are due to add nearly 1.8 lakh barrels per day of crude production going forward, and this is their own plan that they had guided earlier, and this is to restore the production losses that they had seen earlier. Apart from that, on the demand side, if you look at China's economy continues to remain soft. Manufacturing data for the month of August was at a 6-month low, and China is the world's largest crude oil importer. So the demand supply dynamics is changing, and now we are seeing more supply coming in, and the demand continues to remain weak. Now, India definitely benefits because of this, because more than 80% of our crude requirement is imported, and companies that tend to benefit more from this, firstly, is the oil marketing companies, because the fall in crude oil prices definitely boost up their marketing margin. Currently, if you look at the gross marketing margin that oil marketing companies are earning on petrol and diesel, it stands at around 11.6 rupees and 9.1 rupees per litre, which means that they earn this much amount of money by selling every litre of petrol, and these both margins are at a multi-quarter high. And as per analysts, every 0.5 litre change in the fuel margin increases the EBITDA of Indian Oil Corporation, BPCL and HPCL anywhere between 7 to 11 odd %. Apart from this, it's the paint companies, aviation companies, lubricant manufacturers, tire and a host of chemical companies that tend to benefit. Also, cement manufacturers benefit because nearly 40 to 50% of that cost are either directly or indirectly related to crude oil prices. Obviously, they'll benefit it with a lag because the fall in crude oil prices will reflect in the raw material prices with a lag impact. Also, lower crude prices is negative for oil explorers like ONGC, Oil India, HOEC, because lower crude means lower realizations for them. And as per analyst, every 5% or $5 per barrel drop in the Brent crude prices reduces the EPS for ONGC and Oil India by around 7 to 12 odd %. So keep an eye out for all these companies in trade today.
Right, and weighing in on the crude situation, we are joined by Bjarne Shcieldrop, who's the Chief Commodity Analyst at SEB from Norway. Hi, Mr. Shcieldrop. Thank you so much for joining us today. Mr. Shcieldrop, oil prices have extended declines after a report that Libya's oil production was set to be restored, and OPEC Plus plans to raise output amid the weakness in China and US's economy. Now, China is the world's largest importer of crude. Are we really staring at a sharp slowdown in China's oil demand, the bulk of which is now owed to the shift probably from oil to natural gas and the power via EVs, and of course the weakness in the China's economy? What will this mean for the oil prices going ahead?
China is definitely at the heart of the concerns in the oil market. China has accounted for close to 40% of oil demand growth for a decade or more. So with China now looking at net crude and oil product imports for the first 7 months of the year was down 1.5 to 2% year on year. You know, this is very, very unusual to have a contraction in net imports to China. And the current concerns now are, of course, that this is going to be yet worse in the second half, looking at the signals coming out of the Chinese economy with carnage in the steel industry, the heavy part of the industry. So China is absolutely a key element in the market concern for oil right now.
Right. Also, do you see a revival in demand for crude anytime soon? Like, falling crude prices is good news for at least for a lot of Indian companies like paint, cement, tires, the oil marketing companies in India. For how long can we enjoy the fall in crude prices before the demand recovers?
Lower oil price is most definitely very positive for the global economy. And it's also very positive in terms of inflation expectations. You know, now the oil price is down year on year, so it actually has a deflationary effect on the global economy. It basically means that central banks across the world don't have to fight inflation anymore. They can concentrate on balancing their economies rather than fighting inflation. So in that respect, you know, a colleague of mine said the Fed put is back. The Fed is now in a position where it is able, if needed, to rescue the market, to rescue the US economy if needed, because it doesn't have to fight inflation anymore. It can cut interest rates if needed, if the market deteriorates too much. So this is very positive. It creates a less downside risk and more stable economic situation and outlook situation just from that perspective. I don't think we're going to have a massive rebound in the oil price quite yet. We have an expected forecast oil price for next year of $75. Why is it lower? Several things. Yes, China is weaker, but also OPEC wants to add more barrels into the market. OPEC has been cutting deep since the start of 2020, and it wants to put some of these volumes back into the market, get a more normal level of production, so that it is indeed in a position where it can cut yet again if needed under circumstances. At the moment, the market is very uncertain about how much will actually OPEC put back into the market of oil. How quickly will it do it? How aggressive will it do it? So it's both the concerns about Chinese demand on the one hand and added barrels from OPEC on the others. These two uncertainties is driving the oil price lower.
Right. As you rightly pointed out, lower oil prices is good news for the global economy, but Wall Street is coming off a losing session with a major benchmark posting their worst day going back to August 5th sell-off. Chip names are also under pressure. The latest economic data implies slowdown in the growth of the US economy. Are the recessionary fears really back on the table for Wall Street?
We don't think it is. It is not our main scenario. We actually do think that the US Fed is in a much better position to step in if needed. So it actually should create some cushion on the downside for further sell-off. But we've been skyrocketing this year on artificial intelligence expectations. The big tech companies. So maybe we have a sell-off in that, but that doesn't necessarily mean that we're going to go down the drain on the US economy.
Right. Also, with Fed set to begin cutting rates in a few weeks now, the main question is how big the first reduction is likely to be. The monthly US employment data is also due on Friday, which will determine which is likely to determine the answer. But because Fed Chair Jerome Powell made it very clear on August 23rd speech that the central bank is now more concerned about the risks to the labor market, that inflation and another bad report could bolster the case of an outsized rate cut.
Indeed, so I think the Fed now is in a position to be adaptive, to be more aggressive if needed, because, inflation have come down to the point where that is not the big scare anymore. Now it can focus solely on the US economy and the development, either going badly, then it can cut more. If it's going well, it doesn't need to cut so rapidly.
All right, Mr. Shcieldrop, thank you so much for joining us and weighing in on the situation. With that, we will let you go.
If you like this video, then like, share and subscribe to ET Now.